Hello friends, myself Mitesh Ajit Save and my presentation topic is different type of mergers for the subject of corporate valuation, mergers and acquisition. What is merger? Strategic tools in the hands of management to achieve greater efficiency by exploiting scenarios. Second, arrangement whereby two or more existing companies combine into one company. Third, shareholders of the transferor company received shares in the merged company in exchange for the shares held by them in the transferor company as per the agreed exchange ratio. Advantages of merger. First, does not require cash. Second, accomplished tax free for both parties. Third, lets the target realize the appreciation potential of the merged entity instead of being limited to sales proceeds. Next, allow shareholders of smaller entities to own a smaller piece of a large piece, increasing their overall net worth. Merger of a privately held company into a publicly held company allows the target company shareholders to receive a public company stock. Next, allows the acquirer to avoid many of the costly and time consuming aspects of asset purchase, such as the assignment of licenses and bulk sale notification. The disadvantage of merger. This economic of the say scale of a business become too large, which leads to higher unit cost. Clashes of culture between different type of businesses can occur, reducing the effectiveness of the integration. May need to make some workers revenue, especially at management levels. This may have an effect on motivation. Next, may be a conflict of objective between different businesses, meaning decisions are more difficult to make and causing disruption in the running of the business. Procedure for merger. Stage 1. Application to the court. Parties are for compromise and arrangement, a company and its creditors. Third, a company and its member. Application to the court can be made by the company, liquidator, creditor, or member. The application must be accompanied by a scheme of compromise and arrangement. Second stage, direction by the court. The court shall give direction for holding the meeting only if it is satisfied that the scheme of arrangement is workable and reasonable. Meeting shall be conducted in manner as directed by court. The court has no power to dispense with the holding of meeting, even though the shareholders might have on an approach the scheme. Stage 3. Notice of compromise and arrangement. First, the notice shall be given by the court to CG. CG has right to make a representation in respect of compromise and arrangement. Representation must be considered by the court, but it is not bound by representation. Second, notice calling the meeting shall be sent to the members or creditors. The notice shall contain terms and effect of compromise or arrangement, material interest of directions or on manager, and interest of debenture trustee. Next, every director, manager and debenture trustee shall their interest in the scheme and how their interest will be affected by scheme. Stage 4. the scheme by creditors, members, and conditions. First, the scheme must be approved by a majority in number of creditors or members who are present and voting. The creditors or members approving the scheme must represent third in value of creditors members who are present and voting. The scheme must be approved by equity shareholders as well as preference shareholders. Such approval may be received in a meeting of equity and preference shareholders or in a separate meeting as per order of the court. Stage 5. Court to be satisfied that scheme is bona fide. Compliance or direction of the court in holding the meeting provides by of the Companies Act arrangement is real and was accepted by a competition authority. Disclosure of material facts including latest financial position, authorities report and other information, members or creditors or any class of them are fairly represented by those who attend the meeting. The majority is not coercing minority. There is no oblique motive of the scheme. Scheme is based on commercial consideration, workable, feasible, financially visible, and in public interest. Scheme is in interest of company members or creditors. Majority is acting responsibly, prudent, and bona fide. 6. Sanction of the scheme. It is discretion of the court to sanction or reject the scheme. Stage 7. Filing of the order of the court with the register. The scheme become binding only on the filing of the court orders with the registrar. Reason for merger, industry consolidation, tactical move that enables a company to reposition itself with a merger partner into a stronger operational and competitive industry position, improve competition position, reduce competition and allow the combined firm to use its resources more efficiently, defensive, more attractive technical move in any economic environment, particularly in a cyclical downturn where a merger can be a strong defensive merge. Synergy, allowing two companies to work more efficiently toward than either would separately. Market, business, product line issue, whether the market is a new product, a business line, or a geographical region, market entry or expansion is a powerful reason for merger. Acquire resource and skill to obtain access to the resources of another company or to combine the resources of the types of mergers. Horizontal mergers occurs when two companies will sell similar product to the same market. Vertical merger it joins two companies that may not compete with each other but exist in the same supply chain. Market extension mergers to help two organizations that may provide similar products and services grow into markets where they are currently weak. Product extension mergers may merge when they sell product into different of same market. Conglomerate merger occurs when two organizations sell product in completely different market. Diversity in business portfolio is one of the key benefits. A study of HDFC Bank and Central Bank of Punjab 2009, the largest merger and represents the beginning of the consolidation where in the BFSI sector, bank main task was harmonize the accounting policies and as a result HDFC Bank took a hit of rupees 70 crores to stimulate the policies or of where itself of the 70% were towards the harmonization of accounting policies relating to loan loss provisions and depreciation of assets, and the balance 30% reserve right of were towards the merger related in cost like stamp duty, HR and IT indirect expenses.